This real estate investor lost a $42,000 tax deduction trying to run the short-term rental tax loophole, but they executed it pretty poorly. So in this video, I want to go over what happened and what they could have done a little bit differently. We're going to be looking at a tax court case called Lucero versus Commissioner that was decided back in 2020, but I'm going to go ahead and pull that up on my screen now. Okay, so here we have the opinion for Lucero versus Commissioner, as you can see, filed in 2020. Let's go ahead and just scroll right down to the narrative here. So here they're describing the actual rental property and beginning to give us the picture of what's going on. So the taxpayer, Lucero, owned a property called the Sea Ranch property in California, and it was several hours from their home in Sacramento, California, and that's going to come into play here in a few minutes. The taxpayer, he rented the property to tenants for 146 days in 2014 and 152 days in 2015. They paid a property manager called Sea Ranch Escapes. It's kind of, Sea Ranch property, Sea Ranch Escapes, kind of confusing, but Sea Ranch Escapes is the property manager. Remember that because that's going to come up later as well. The manager did advertising, collected deposits, maintained, cleaned the property, landscaping, assisting in hiring repairs and responding to tenants. Kind of already sounds like a losing case, right? The property manager that the taxpayer hired is doing a lot of the day-to-day work. Mr. Lucero, the taxpayer, retained control over administrative decisions, setted rental rates, approved expenses over $100 to save money. So this is kind of where it gets maybe not as clear cut as they definitely lose. This is where it gets a little interesting. The taxpayer, to save money, performed some upkeep on the property themselves. They drove to Sea Ranch property approximately 6 to 9 times each year to do landscaping, cleaning, inventory, and to oversee necessary repairs. In 2015, they also went and they cleaned and decorated and did some inventory. They would stay multiple nights at the Sea Ranch property, but they did not keep any contemporaneous time logs, calendars, or other documentation stating the number of hours that they spent on the activities related to the short-term rental. They did attempt to reconstruct that time log using invoices, receipts, and the number of hours that was spent on the activities once they were under audit. And per that reconstruction, they decided that they spent roughly 267 hours in 2014 and 273 hours in 2015. So we know what they're trying to target, right? They're trying to target the 100 hours in more than anyone else material participation test, because that is what's required for the short-term rental loophole. You must also rent your property on for an average period of 7 days or less, so that you don't have to qualify as a real estate professional. So if you have a short-term rental, rent it for 7 days or less, and you materially participate, then you can use the tax losses to offset your regular income without having to jump through the real estate professional status hoops. So that's what they were trying to do. But let's see what the tax court says. Okay, so they look at their tax returns and they see that we've got rents of 26,000, expenses of 43K. So the tax loss was $17,000, and this was in 2014. In 2015, rents of 26, expenses 51, loss of $24,000. So combined in 2014 and 15, got roughly a $42,000 tax loss that they claimed from this short-term rental. So they were effectively running the short-term rental using the tax losses to offset their W-2 income. So if we scroll down here to more of the analysis, the first question that the tax court wanted to answer is, did the taxpayers use the short-term rental as a personal residence? Because if you use your short-term rental as a personal residence, you cannot claim the tax losses. They become capped at rents, at income. And that's like actually a trap that sometimes investors fall into when they buy a short-term rental in a cool vacation place, right? They'll rent it out a lot, but then they trip the personal use rules. And even if they cost segregate it and bonus depreciate it, they're not able to claim the tax losses against their W-2 income because they used it as a personal residence. So the personal use rules are 14 days or 10% of the total days that the rental is rented at a fair market value. Now, what that means is if I buy a beach home and I use it for 15 days, I have tripped the personal use rules and the losses I can't be using against my W-2 income. That's test one. Or if I rented my beach house for 300 days, then it's no longer 14 days. That's not the test anymore. It's 10% of the total rented days. So in this case, since I rented it for 300 days, the test would be, or the trip would be 30 days. So if I spent 31 days in my property, then I would be tripping the personal use rule. So it's 14 days or 10% of the total days rented, whichever is greater. And so they go through here and they basically say, since Lucero spent the days primarily repairing and maintaining the unit, that their days spent at the unit are not going to count for personal use days. And so they basically say it was not a personal residence. And so that's good for the Luceros, right? So that's a check mark for the taxpayers. Good. We passed that test. We don't have to worry about our losses being capped due to the residence rules. However, we still have the passive loss rules that we have to get through here. Now, here is where the short-term rental loophole kind of comes into play. So if you see here, it says an activity that involves the use of tangible property, it's not going to be considered a rental property, or sorry, a rental activity. Activity is the key word. As long as the average period of customer use is 7 days or less. Now, why is that the key word? Because a real estate professional status only applies to rental activities. And so if I don't have a rental activity, then I don't have to qualify as a real estate professional. And that is important because real estate professional status is what prevents people with full-time jobs and full-time businesses like myself from qualifying or from being able to use my tax losses for my rental properties. And the reason that real estate professional status prevents me and other people working full-time jobs from using their rental losses to offset our regular income is because one of the tests to qualify as a real estate professional is to spend more time in real estate than we do at our regular jobs or running our business. Because I do this full time, I can't possibly spend more time in real estate than what I'm doing right now. So I can't qualify as a real estate professional. And that means that my rental losses are all passive. But if the average period of customer use is 7 days or less, I don't have a rental activity. Real estate professional status only applies to rental activities. So if the average period of customer use is 7 days or less, then I don't have to worry about qualifying as a real estate pro. And that just means that I can buy short-term rentals and use the tax losses to offset my W-2 income, even when I'm working a full-time job, because I don't have to spend more time in real estate than working at my full-time job. That's the crux of the short-term rental loophole. So on average, the Sea Ranch properties was used for less than 7 days. So they were short-term rentals. So then we move on to material participation. And first, we have to be involved on a regular, continuous, and substantial basis. And we have to meet one of the 7 material participation tests. Now, the test that the Luceros are going to go after is the 100 hours and more than anyone else test, as we can see here. So they wanted to meet the 100 hours and more than anyone else test. Now, they relied on the time log that they created while they were in IRS appeal. So we're already shooting ourselves in the foot. We've already lost credibility because we are retroactively creating a time log, which is just going to be there to benefit us in our case, right? So we automatically lose some credibility. Now, the time log that they created has a lot of time spent paying bills, coordinating with the property manager. Sea Ranch Escapes, remember, is the property manager, and preparing their tax returns. Those are all investor level hours, and those do not count unless the individual is involved in the day-to-day management of the activity. However, the tax court says you were not involved in the day-to-day management because you hired Sea Ranch Escapes to manage the day-to-day. So none of that time is going to count. Additionally, they excluded the time that the Luceros put on their time log to log the travel time, the time spent driving between Sea Ranch property and their home in Sacramento. And they said this because they bear the expense of commuting because it's a personal expense unless an allocation for additional expenses can be made between personal and business expenses. And lastly, they said that the time log had excessive hours on it. So specifically, spending 2 hours shopping for coffee filters at Bed Bath & Beyond. I mean, how realistic is that, right? 1 hour shopping at, I don't know how you say that, supermarket for 2 items. And then basically they just said, we found the credibility to be diminished when the number of hours reported appears excessive in relation to the task described. And so they said, because of these defects, we don't even need to look at the rest of the stuff. The log's not reliable. It's just ballpark guesstimates, and we don't have to accept it. So they said you're not materially participating and the taxpayer's loss. But then they went a little bit further, which is kind of interesting. So they said, even if we were to assume that you did spend 100 hours, so even if your time log was good, and even if we did assume that you spent at least 100 hours on this activity, you did not include any documentation to show the number of hours of any other individual, such as the property manager. Now, why is that important? Because remember, the material participation test that these guys were going after was 100 hours and more than anyone else. And so the tax court here is saying, hey, even if you got your 100 hours, you didn't show us any evidence as to how much time anyone else spent on the property. So how could we possibly ascertain whether or not you spent more time than anyone else if you don't show us what anyone else spent? That's very interesting, and it's a good kind of warning shot across the bow for anybody that has short-term rentals. You have to track your property manager's time, your cleaner's time, your maintenance man time. You have to track all that, because you're eventually, if you were to be audited and then go to tax court, you would have to be able to prove that not only did I spend 100 hours working in my rental, but I also outworked everybody else that was participating in this rental activity. So they did not present any other evidence. They failed to show that their time exceeded any other individual, so they denied it. So basically, the taxpayers here had a $42,000 tax loss between 2014 and 2015 reversed. They owed back taxes, and I believe also penalties and interest. But because they ran the short-term rental loophole, but what did they do? They didn't do the number one thing that we always tell people to do, which is track your time. You have to be religious about it. If you're going to run the short-term rental loophole and you're not good at documenting, you need to outsource it. Hire a VA, hire a bookkeeper. Our firm does a lot of bookkeeping for short-term rentals. You have to do something to document your participation in the activity on an ongoing basis. Otherwise, you could end up in an audit, and you could end up going to tax court, and all the tax losses that you claimed with the cost seg and the bonus depreciation can be blown up and reversed, and you'll be left holding the bag of back taxes, penalties, and interest.